Most people work hard to earn money, sacrifice their time, energy, and focus on climbing the corporate ladder or building a successful business. But very few of them know how to make money work for them, and that's where the real wealth is built. So here's how you should invest your money. Step 1. Build a safety net. If you don't have any savings, then you need to start there. Set aside 3 to 6 months of your living expenses in an emergency fund. This should be enough to cover your rent, bills, and other essential costs if you lose your job, get sick, or experience any unexpected events. The best place to keep your emergency fund is in a savings account that offers a high interest rate. This way you can easily access your money when you need it, without risking any losses. You can also consider keeping some cash in a money market fund, which typically offers higher yields than savings accounts, while still being very liquid. A good rule of thumb is to keep 3 to 6 months of living expenses in your emergency fund. Having this safety net can give you peace of mind and prevent you from dipping into your long-term investments during tough times. Once you've built your emergency fund, it's time to move on to the next step, which is paying off your bad debt. Step 2. Pay off bad debt. Any outstanding credit card debt, personal loans, or payday loans with high interest rates should be paid off as soon as possible. Bad debt can quickly spiral out of control and become a major obstacle to achieving your financial goals. When you pay off your debt, you free up more of your income to invest and potentially earn a higher return than the interest rate you were paying on your debt. By focusing on paying off your debt first, you can avoid the high interest charges that can eat away at your profits and set yourself up for long-term success. Step 3. Start with index funds or ETFs. Index funds and ETFs are investment portfolios that contain a wide range of securities such as stocks, bonds, or other assets. They allow investors to diversify their holdings and invest in a variety of assets with a single purchase. Index funds and ETFs are a great option for beginners because they offer a low-cost, low-maintenance way to invest in the stock market. They're also often less volatile than individual stocks, making them a good choice for investors who aren't comfortable with high-risk investments. One popular index fund is the S&P 500 ETF, which tracks the performance of the stock market. By investing in the S&P 500, you can get exposure to some of the biggest and most successful companies in the world. Step 4. Add dividend stocks. Dividend stocks are shares of ownership in a company that pays out a portion of its profits to shareholders on a regular basis. Typically, these payments are made every quarter, and the amount of each payment is determined by the company's board of directors. Dividend stocks can be a great addition to your portfolio because they provide a way to generate passive income without having to sell any of your shares. This can help you supplement your income and reduce your reliance on your day job. Some popular dividend stocks include companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies have a history of paying out reliable dividends and have demonstrated their ability to sustain their payouts over time. Step 5. Diversify. Diversification is an important part of any investment strategy because it helps to reduce risk and increase the potential for long-term growth. By spreading your investments across different asset classes, industries, and geographical regions, you can minimize the impact of any single investment performing poorly and maximize the chances that your portfolio will grow over time. For example, you might invest in a mix of stocks, bonds, and real estate. You could also diversify within each asset class by investing in a range of different companies, industries, and countries. For instance, if you're invested in stocks, you might consider investing in a mix of large cap, mid cap, and small cap companies across different sectors like technology, healthcare, and consumer goods. You might also want to consider investing in international stocks to get exposure to the global economy. Step 6. Be consistent. Consistency is key when it comes to investing because it can help you stay focused on your financial goals and avoid making impulsive decisions. By investing a fixed amount every month, you can take advantage of dollar cost averaging, which is a strategy that involves buying investments regularly, regardless of the market conditions. Dollar cost averaging can help you buy more shares when the market is down and fewer shares when the market is up, which can help you reduce the average cost of your investment over time. This can be a great way to invest in the stock market without having to time your investments just right. Some popular investment platforms make it easy to set up automatic investments so that you can stay consistent with your investing even when you're busy. Investing is a powerful tool that can help you grow your wealth and achieve your financial goals. However, it's important to remember that investing is not a get-rich-quick scheme and that it takes time, patience, and discipline to build wealth. So follow these steps, stay consistent, and remember that long-term success is more important than short-term gains. Now, if you liked this video, please make sure to leave us a thumbs up, as we always appreciate your support. Also, don't forget to subscribe so you'll be notified whenever we upload a new video. Thank you for watching, and we hope to see you again soon.